Okay, so we start now. So, who is the most influential person in the world? 10 years ago, your answer must be Steve Jobs. But today, the answer will definitely be Elon Musk, who challenged traditional oil cars, founded Tesla, opened a new energy era, and brought more green and peace to the world. Just as the picture shows, among the components of an electric car, EV battery is the most crucial and revolutionary part. So today, we're going to look at an EV battery manufacturer, CATL. For a brief overview, CATL's main business includes three parts: EV battery, energy storage system, and lithium battery material, while EV battery occupies over 80%. The company showed outstanding performance since its IPO in 2018, and its revenue reached 46 billion in 2019. With a growth rate of 68%, CATL is the absolute leader in the EV battery industry in China. After a deep research on CATL, we, Shanghai Jiao University, are convinced by its bright future and strongly recommend CATL as our target firm, with a target price of 289 yuan and 14% upside.
So why cattle? The reasons are from the four aspects: booming EV industry and cattle's dominant position, advanced technology, and strong financials. Let's start with the first, booming industry. In the past, EV battery industry experienced a 5-year CAGR of 76%, while Chinese market accounted for more than half share. This rocketing trend is driven by EV penetration to traditional petrol vehicles. Even if EV industry grew really fast in past few years, the penetration rate is still less than 5%. So in the future, this market is certain to continue booming. The most important driver behind this penetration is policy. Many countries have top-level policy about transition to new energy vehicle. Under the guidance of detailed and applicable policies, China's EV industry leads the whole world, experiencing shifts in vehicle type and evolution in technology, creating opportunity for high-tech domestic battery makers such as CATL. And in this booming industry, CATL is the absolute leader. EV battery industry has very high moat. Over the years, large EV battery oligopolies have been consolidating the market with their stronger technology, large-scale advantage, and existing industry cooperation. Among all the oligopolies, CATL is the strongest. Its sales rank first in the world and dominate in all battery and EV category in China. With its dominance, CATL established cooperation with 80% world's largest EV makers and almost all major OEMs in China, far exceeding its international competitors. These vast cooperation guarantee CATL's revenue and help CATL further consolidate the market. Because of its first mover advantage and continuous R&D expenditure, CATL's competitive position become even stronger in recent years.
How CATL realized its dominance? Technology. CATL is strong both in high performance and low price fields, which guarantees its future market share and high barrier. For high performance, CATL takes the lead in mass production of NCM A11, with energy density reach 280. For low price, CATL designs CTP batteries, reducing the number of connections by 200 and resulting in a much cheaper price. Such design layout enable CATL to provide multiple possibilities for OEMs. Statistic-wise, NCM's ED is 50% higher than LFP, while LFP can tolerate much higher temperature and material cost is 30% cheaper. Competition-wise, domestically, CATL CTP tech could combine with high-nickel battery to provide a high energy density plus high safety option. Internationally, while other large players are focused in high-performance fields, CATL is the only one to have two key tech nodes. In addition, currently CATL even surpassed Panasonic and LG Chem in energy density. Such strong tech is backed by high R&D imports, fast-growing researchers percentage, highest domestic expense per person, and surpassing LG Chem's expense ratio. For future, CATL also demonstrates strong ambition. Long life and zero nickel batteries are both under development.
Except for tech and market position, CATL also established a satisfying financial basis. CATL transcends competitors on cost management, which leads to a higher margin than what contributes to its cost advantage. Since CATL ranked first in market share, substantial orders cut down the unit cost through economies of scale. And its industry chain layout also helps. CATL heavily invested its upstream company, with the strongest bargaining power in cathode and precursor. It also locked international lithium, nickel resources in advance. Deep industry chain cooperation effectively reduces the operational cost, while the business synergy with ATL avoids duplication of research and development, which enables Cato to dilute R&D costs. Cato stands out with its excellent solvency capacity. With its large amount of idle monetary funds bringing huge interest income, Cato's interest coverage multiple greatly exceeds its competitors. Cato also has a healthy debt-asset ratio, while it will be able to generate higher returns for shareholders through current expanding debt leverage. Then we could find that Cato's net operating cash flow has been showing growth since 2015, fully covering its capital expenditure. This not only indicates its prominent profitability, it is also a signal of Cato's forceful payable collecting ability.
So how much cattle is worth? We use DCF and multiple approach to evaluate cattle and took an average to get our target price of 289 yuan. In DCF valuation, we use top-down method to forecast cattle's operating revenue. Take EV battery as an example. In the domestic market, cattle is likely to keep its leading role and maintain a 40% market share until 2029. In the overseas market, we could foresee an active expansion, especially in Europe. Cattle's market share will exceed 30% in Europe alone and reach 22% in the whole overseas market. As for WACC calculation, we regressed on CSI to 100 return and got beta of 1.28. Considering technology risk, we only assumed a perpetual growth rate of 1.5%. However, our DCF target price is still 18% higher than current price. After that, we also carried out relative valuation based on PE ratio and EV/EBITDA. Because of Cattle's more conservative financials, such as the much shorter depreciation life, we believe that EV/EBITDA could serve as a better method, which yields a target price of 275 yuan. Finally, we varied WACC and perpetual growth, studied different cases according to production capacity and double credit policy, and conducted Monte Carlo analysis. And considering recent evidence on policy and company performance, we analyzed the bull case with a higher growth and greater potential, which yields a target price of 405 yuan.
Based on the previous research, we conduct our risk matrix analysis. We would divide risks into 4 categories. Among them, financial and policy risk are low because Cattle's conservative accounting treatment and government's favorable attitude. For technical risk, since its huge input in R&D and high bearing dispute, the risk is moderate. Now let's talk about its market risk. With Cattle's overseas expansion plan, it will unavoidably compete with international EV battery leaders like LG Chem and Panasonic. The ambitious OEMs such as BYD and Tesla made the competition even fiercer. However, with the stable up and downstream relationship, tech advantage, and leading position over the world, Cattle can control this risk. As for substitute like hydrogen fuel vehicles, they impose no threat in the short term. As for ESG, it has become one of the most popular indicators for investors in stock picking because it guarantees the sustainable competitiveness. According to the 3 above rating agencies, Cattle's ESG performance is strong. Environmental friendliness is quite important to EV battery company, and Cattle has strong ability in this pillar. In terms of hazardous waste per revenue, it is as good as Panasonic and even wins LG Chem. Besides, Cattle achieved this with very low expenditure. Governance is crucial to the long-term value of a company, and Cattle has excellent historical records in this pillar, because the core management team is good at grabbing opportunity. Besides, the well-designed incentive plans also make sure that the strategic advantage from the top can be delivered to daily operations successfully.
In conclusion, Cattle is a leading firm in a promising industry. With its technology advantage, industrial chain integration, strong financials, and excellent corporate governance, its leading position will continue. Its long-run profit is guaranteed. After we conducted our valuation because of the accelerating penetration of electric vehicle and Cattle's announcement of its capacity expansion plan, Cattle's revenue growth seems more certain, and its stock price has been rocketing consequently, which in turn proves Cattle to be worth investing in. This is Cattle, an outstanding Chinese EV battery company with promising future. Thank you for your time, and now we are open to our questions.
Thank you. Judges, at this time, please turn on your video. Stay muted unless you are speaking. I will start time as soon as the first judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Okay, maybe I'll start with the first question. Given you just said that the company outlook has changed quite a bit, how would you change your current valuation model then? And why not change it given that we're presenting on April? Yeah.
Okay, so for the DCF valuation and especially the revenue projection, we still use the top-down method in our revenue projection, especially in the EV battery business in the domestic market. So there is not much change in the method we use to project the revenue. And so what have changed is that they launched a series of new projects both in the domestic market and in the overseas market. For example, in the December last year, it launched 3 projects in Liyang and Ningde in China, and also the one in Indonesia. And this will cause the revenue to increase about 25% in 2020 and 20% in 2021. And we also report our change in our presentation at the end of the valuation part. Yes.
Which slide?
The one I think in, yes, this one. So the change is more like the bull case in the valuation part.
Okay, got it.
Thank you. Thank you for your question.
Could we turn to the relative valuation comparison for a moment? Because PE of 100, EV to EBITDA 57, I'm not sure if that's what you're saying is the right valuation, but they're very high relative to Cattle's own history. They're very high relative to other periods in time. What gives you faith that these are sustainable, justifiable valuation multiples rather than the sign of a bubble in EVs and all things EV related?
Okay, thank you for your question. We understand that currently Cattle's PE is at an extremely high position. But on one hand, it's due to Cattle's leading position and the prosperous industry environment. Also, on the other hand, based on our focus that the Cattle's EPS will grow really fast in future. So we expect that the PE ratio will go back to 60 to 70 in 2022, which will be along with the company's historical stock price performance, and its foreign, and also it will be along with its foreign competitors like the Samsung SDI. So we think even now it's really high, but in future it will slowly go down to a reasonable range.
And actually, I think our valuation is kind of conservative because not only for its EV battery part of business, it also has business in the energy storage business, which is quite related to that carbon neutral goal. And as Chinese government climate commitment said, it aimed to have the carbon dioxide emission peak before 2030 and achieve carbon neutrality before 2060. So actually for this business, it has long-term potential. Yeah. Thank you for your question.
Thank you.
Thank you for your presentation. There was a key driver which was mentioned that they had dominance of the local market because of the regulation on ban of entry of foreign players, but that has now gone. And you had a slide where in 2020, we see a fall in their market share, and they're actually number 2 behind LG. So how have you factored in the growth, given that competitors are going to obviously invest, and how have you adjusted your revenue projections, given that that exclusivity they had on Chinese market is no longer there?
Okay, so thank you for your question. And we noticed that the whitelist policy in China has already been abolished in 2019. And after that, actually many foreign competitors such as LG Chem and Panasonic, they all enter our Chinese market. So it's possible that in China, our cattle will no longer account for more than half share in Chinese market. But since the cooperation between the EV makers and these battery makers is a strategic cooperation, is not just some buy and sell. It's about some technical cooperation. They need to send their tech guys to cooperate, and they need to talk a lot of things about the cars, about the battery types. And after that, they can cooperate, and the EV makers will purchase battery from cattle or these battery companies. So in the future, we believe in China, cattle will still dominate. In our projection, it's 40% of China's EV battery market, because we think cattle is a Chinese company, and it's has already established many cooperation with our Chinese companies. So in the future, even if these foreign competitors will enter China, and actually in last year, LG Chem and Panasonic, they are all battery instrument here in China is based on their cooperation with Tesla. They do not fully enter into many other local China's EV makers supply chain. So it's possible that cattle will still have some dominant power in this market. And as for the overseas market, we believe cattle, since its strategy to enter overseas market, and it has already built many factories in the European area, we believe in the future cattle may have certain market share, especially in the European area, because according to the interview to the board of director of cattle, they are invited to build their factory in European area, because these European EV car makers, when they enter Chinese market, they feel cattle is a very good partner, so they want cattle to build factory in European area. So we believe in the future, cattle's market share in China will slightly decrease, while cattle can occupy a much bigger share in the European market or some other market. And that's how we think about the future competition landscape of EV battery, and that's how we do our projection. Thank you for your question.
In fact, in our valuation part, we actually assume that the domestic market share will be no less than 40% at the end, in which we believe that cattle will still have some advantage in the domestic market. But we also take a very conservative method in predicting the market share in the overseas market, and we believe that the upside of the market share in the overseas market can compensate that in the domestic market. Yes, thank you.
Hi, let me ask you a question. So you showed 3 valuation methods you use for this firm: a DCF, price to earnings, and EV to EBITDA. And obviously, valuing a growth firm is not easy. Is there any particular valuation metric out of the 3 that you focused on that you thought would be more suitable for this firm or for growth companies? Or did you just do an average? Or are there any other metric that you potentially considered apart from these 3?
Sorry, I'm not sure what do you mean about the 3 method, because we only use one method for our DCF valuation.
I mean, so you talked about DCF, price to earnings, and EV to EBITDA.
Yes.
Out of those, what did you think any of the one would be most appropriate for valuing this company, or did you just did a certain average of the methods?
Yes, well, we took an average to get our target price, and because we believe that every method has its advantage. For example, the DCF valuation can can help us learn more about the revenue, the trend of the future of this company. But the relative valuation method like the P ratio and EV/EBITDA could help we consider more to compare it with the market. Yes, so finally we took an average of this DCF valuation target price and relative valuation target price.
Thank you.
Thank you.
Time. Thank you, Shanghai Jiao Tong University.